So, you got $1,000 and you want to buy some dividend paying stocks. Well, let's put our investing hats on. Hold on, let me get mine. And talk about how we are going to invest $1,000 into dividend paying stocks. Now, I'm going to show you how to do this through the platform Charles Schwab. Let's get started. Don't forget to like, comment, and subscribe if you enjoy this material. Let's go!
GameStop to the moon, AMC to the moon, all our stocks to the moon, Dogecoin to the moon. That is not a stock though, doesn't matter, to the moon. I feel like I'm JFK, cause I'm headed to the moon.
Technically, I had to take off my investing hat to put my headphones on, but it's still on. Like, look right here. It's attached to my neck, so you know I'm a honest person. Anyways, making dividend portfolio starting with $1,000. Let's check out why we even want to make one of these in the first place. Because isn't Bitcoin always going up? What's up with that? Why would we even bother with something like a dividend portfolio? Well, let's talk about the pros. It creates a passive stream of income. And it doesn't get any better than that. This means you buy these stocks, and in the future, you're just going to be collecting this passive stream of money. That's awesome. What else though? That's definitely not enough. Purchasing power during market crashes. That's right. When the stock market crashes, these dividend paying stocks are still paying you dividends, meaning you can reinvest those dividends into the same stocks. So you're actually buying stocks at really low prices, or relatively low prices if there's a market crash. During 1930, the dividend yield was so high during the Great Depression, where investors were having 14% average dividend yields from the top 30 companies. I know that's a little off topic and overwhelming, but hopefully by the end of this video, a lot of that is going to make more sense. History's on your side. I just mentioned 1930s. That was pretty good. Non-scripted, by the way. History is definitely on your side when it comes to dividend paying stocks. A lot of the stocks that I'm going to be talking about have been paying out a dividend for decades. These are called the Dividend Aristocrats. In order to make it on this list, you need to pay out a dividend for 25 years in a row and have been gradually increasing it year by year by year, no matter what happens. And there's probably something covering my face right now. And if you click that link, it'll take you to a video about Dividends 101. And if you're back from that video or you never left, you're still here, don't forget to drop a like if you're enjoying this, and drop a comment. Oh, Dividend Aristocrat. Oh, that's pretty cool. So Dividend Aristocrats, we got that down 25 years. And yeah, they pay out those consistent dividends. But then what are the cons to dividend portfolios? They give out all this passive income, purchasing power during crashes. They have decades of growth on their side. Well, they do require some research. It's not like you could just buy a dividend paying stock and there you go. Yeah, it doesn't work like that. And here's another reason why. Dividends are never guaranteed. Macy's was paying out like a 10% dividend in 2020. That's gone. Disney, oh my gosh, a company as solid as Disney had to stop paying their dividend. Their stock crashed. It is never a good sign when a company stops paying their dividend, at least in the short run. In the long run, it might be great, but that's for another video. Let's see what else we got. If you heard me swallow right there, that was really gross. Drop a like if you thought that was gross. Dividends are also taxed. So one way to avoid this is actually buying dividend-paying stocks in your tax-deferred accounts, especially the Roth IRA. There's probably something covering my face right now again. And that's another video you could click about the Roth IRAs and how they work, where you actually pay zero taxes on all of your profits, like zero. You got $2 million in there, you got $2 million. It's one of my favorite investing accounts, and most people don't even use it like an investing account. They think they just put cash in there and leave it. No, you have to invest it. Let's move on. Let's talk about diversification and dividends. So when you're investing your $1,000, you probably want to break it across a couple sectors. Here's some examples. We got technology and we got healthcare. With tech, we're looking at communications. We're looking at at&t. Notice right there, at&t is paying a whopping 6.6% dividend yield. That's incredible, because the stock market in general, you're hoping for 7 to 10% annually. Here, you're practically guaranteed to get at least 6%. So why doesn't everyone just do that? My mom would if it was 100%. By the way, shout out to my mom if she's watching this. Mom, if you're watching this, don't forget to drop a like and a comment and support your son. But the moral of the story here is at&t does not grow as other stocks have, especially in the recent past. And we'll get to that in a moment, where I'm going to compare at&t to the top 500 companies. So that'll be interesting. But at the very least, you're getting that 6.6% if you buy the stock now. Johnson & Johnson, 2.58%, and it's in healthcare, which we know is a really hot field right now and will probably be growing as time passes, as human beings are living longer and longer. So now let's compare at&t to the S&P 500. S&P 500 is the top 500 companies in the United States, which also includes Johnson & Johnson and at&t. So at&t 37-year annual return average is 14.31%. In 1983, if you had put $1,000 into at&t, well, by 2021, it would be almost $150,000, while the S&P 500 around $62,000. Now, I'm happy with both, but one of these makes me a lot happier than the other. Now, remember, at&t is still an individual stock, which means it's not guaranteed to always go up throughout history. S&P 500 has a way stronger probability to be going up as time passes, or if you watch Rick and Morty, we pass through time. S&P 500 is the average of 500 companies, so odds are if at&t does poorly, there will be a new competitor that does well and joins the S&P 500, and the price of the S&P 500 won't change much, while at&t will greatly suffer. Now, yes, sure, at&t had about 14% average returns for the last 40 years, while the S&P is closer to 11%, but the last 10 years, at&t is only around 5%, while the S&P is way more than 10%. So you know what? You never really know what you're gonna get. But with at&t, you do know. You get that steady dividend yield. Boom shakalaka. Let's check out Johnson & Johnson. Yeah, the numbers are shocking if you look at the screen. 37-year annual return, 22.65%. And for those of you that don't understand how amazing that yield is, well, it leads to your $1,000 in 1983 turning to over $2 million. I don't even mention the $88,645.25 until now, because the S&P doesn't even touch that 88,000. It still had some ways to go. So Johnson & Johnson had an amazing run, and it's very loyal to its shareholders, paying out year after year. In fact, while other companies on the Dividend Aristocrats had to pay out for at least 25 years, Johnson & Johnson has paid out for about 58 years at the time of me recording this video. It makes it no longer a Dividend Aristocrat and dubs it a Dividend King or Queen. Wow. Now let's just look at those numbers side by side. Johnson & Johnson, $2 million, $2,088,000 compared to the S&P, $62,000. You can't really compare that. That's a one-time investment. Imagine you were investing every single month, like $100 into Johnson & Johnson. That would be amazing. And this information is going to be crucial when we're deciding how we're splitting our $1,000. You cannot imagine that Johnson & Johnson would keep its streak going for another 40 years. I mean, it might, but do you really want to bet on that? That's a big gamble. A lot of times when companies do really, really, really well, or ETFs do really, really, really well, maybe there's something popping up on my screen about ETFs and how they work compared to mutual funds and index funds. Usually ETFs do go down and their performance is not as well, especially if they had a great run like the last decade. So let's keep moving here. Maybe we could check out some other ways to diversify. So other sectors when it comes to dividends, consumer staples. Shout out to Staples, but we're not talking about Staples. We're talking about Walmart. Walmart's paying out a 1.5% 1.57% dividend. And this does not mean that AT&T is automatically better than all these other stocks combined. Johnson & Johnson was nowhere near AT&T's 6%, but Walmart's at 1.57, and Edison is at 4%. So that does not make AT&T better, because remember, Johnson & Johnson had so much growth on top of that consistent dividend. So when it comes to Walmart, we're looking at that 1.57, nice. And remember, Walmart is a company that remained open and in business during the pandemic. And that was really, really helpful for society. We needed a place to go, and they sacrificed their front of the line workers. I mean, and they provided let's go on to utilities. So Walmart, I think, did an okay job, but like, honestly, thank you for everyone who was on the front lines during this pandemic. Like, humanity would be so far behind without you, and your jobs are not your jobs. Forget your jobs. Like, you'll always find a new job. But at the end of the day, what you did, it's so much respect. Now, I'm getting a little off topic, so let's get back to utilities. No, thank you from the bottom of my spirit and my soul. Like, I hope this video is going to help you, where you don't have to rely on your 9 to 5 and working and clocking in at Walmart. Hopefully you're investing in companies and not just going in there for like 8 hours and then leaving and hating your life. Now that doesn't mean you hate your life or anything like that. Like, maybe you love your company. I love my 9 to 5. I'm having a great time. Okay, utilities. We have Edison over here, Consolidated Edison, 4% dividend yield, not bad. Its growth is okay. We're going to look a little bit closer at both of these stocks and compare them to the S&P like we did with AT&T and Johnson & Johnson. So let's check this out. Here's Walmart's 37-year annual return, 15.97. Now, after Johnson & Johnson, everything else is just so underwhelming. But this is really good. $1,000 turned to $250,000. I'm not mad at that. If I could guarantee that, oh my gosh, I'd be investing in anything that gives me 15.97%. Forget chasing like these maybes. Like, if I could get this guaranteed, I'm in. But unfortunately, the closest thing you could get to a guarantee is the S&P 500s. Where is it? Right over here. 7 to 10% annual growth, $1,000 turning into $62,000. That's really good though. Most people's $1,000 turns into like zero because they spend it. Actually, it turns into millions of dollars when you spend it, because these corporations are reinvesting it, and they're profiting off of your labor. You should not. Come on, guys, please just start investing. Like, after you drop a like and a comment, make sure that you're investing. And if you haven't subbed to the channel, sub to Funancialism. So $1,000 turns into over $250,000 with Walmart for the last 40 years. I mean 37. Okay, ED, 37-year annual return, 11.74% average return during that time period. 1983, $1,000 in 2021 turns to almost $9,000, which is extremely close to the S&P 500. So what's the benefit here? I would actually love to have Edison rather than the S&P, because they would be paying during that time period, because they would be paying out that steady dividend. The S&P's dividend was much less, and it does pay a dividend, by the way, but it's much less compared to a company like ED. So if I ever wanted to stop investing my dividend payments, I could have just easily took it as cash and bought whatever I needed, groceries and whatnot. So yeah, that's awesome. Now let's do a $1,000 sample. If I'm in my 20s and 30s and I have maybe 0 kids, 1 kid, or very young children, I would do something more aggressive. I would definitely still put something into the index fund. The S&P 500, that's the GOAT of all of investing. So no matter what, something goes into the index fund. I want the average of the top 500 companies in my portfolio, just in case. 200 would go into AT&T. I like their big fat dividend. I think they performed poorly for the last 10 years, and that gives them some room, especially in the stock price, where everyone is saying that stocks are so inflated. Well, AT&T stock price is not as inflated. Maybe it's way closer to the real value of what it's supposed to be, and everything else is just really, really hype up. Maybe AT&T really is behind, but I definitely would put at least $200 into AT&T. Walmart, Walmart is a booming business. Walmart is a business that creates other businesses if you're savvy enough. I know people have been going into Walmart and profiting times 10 off their Pokemon cards there. That's why if you walk into Walmart, you'll probably not see any Pokemon cards. And if you're interested in how to be a Pokemon card millionaire, hopefully there's something on my face right now and prompting you to click. So I would put $300 into Walmart. They have had steady growth. They're a business that's not going anywhere. It is an essential business. And then there's Johnson & Johnson, healthcare. I think that healthcare is going to be expanding over the next 40 years. I don't know if Johnson & Johnson is going to be leading the pack, but it definitely has the resources to lead the pack. So at least my first year investing, my first $1,000, I would go hard on Johnson & Johnson if I'm trying to build a dividend growth portfolio. But if I'm a little bit older, if I'm in my 40s and 50s, well, I'm thinking a lot more about passive income sooner than later. So instead of going hard on something like Johnson & Johnson or Walmart, I want those big, heavy dividend checks. So I'm going into Con Edison, I'm going into at&t, and I am going a little bit harder on the S&P 500 because I still want that top 500 companies. I still want that little dividend that they're paying out. Like, it goes a long way. Why not take it? And if the market's doing well, okay, cool. Maybe these companies are performing poorly, but at least I still have the S&P. Now remember, I also have that 6% being paid out from at&t. What I could do if the market drops and I'm not retired yet, I could, whoa, what the heck is that? I could reinvest that 6% that at&t is paying me into another company that might be underperforming. Maybe I will take Con Edison's dividend payout and at&t's dividend payout and reinvest it into something that's like Johnson & Johnson or Walmart or even the S&P 500. You could just take that reinvested dividend or that dividend payment and put it into something more risky for 1 year. Like if you're in your 40s and 50s, you are just getting started. I want you to think about Warren Buffett for a second, who is 90 years old. And at the time of this recording, he just gave a 4-hour lecture through Yahoo Finances and for Berkshire Hathaway's annual shareholders meeting. And he's kicking butt with Charlie Munger, who's even older than him. But the moral of that story is Warren Buffett was 54 years old and still did not have 1% of his current wealth. Okay, so if you're 54 years old and watching this, multiply your money by about 130. All right, so anything is possible if you're investing, if your money's actually moving with companies, with human innovation, rather than being spent on these companies and on things that don't really bring value into your life for more than 7 minutes. So Charles Schwab, that was not just clickbait. This is what it looks like when you're buying stock slices on Charles Schwab. You just type in the ticker symbol. So for Johnson & Johnson, it's J&J. After that, all you do is you see it pop up. You make sure you check mark it. This is a really cool feature from Charles Schwab, by the way. Stock slices. You could buy pieces of stocks. Before, you had to have that $162.73 to invest and buy 1 share of Johnson & Johnson. Now you could break it up into small fractional increments. We are in the middle of a financial revolution. This has never happened in history before, where investing is so accessible, where if you don't have the $1,620, oh wait, I messed that up, the $162.73, that's okay. You could still break it up and diversify. You don't need tens of thousands to have that nice, smooth diversification anymore. $1,000 is enough. So yeah, on this page, I already knew that there was some sort of glitch. For some reason, Charles Schwab says $136 when we know that the stock cost $164. Glitches happen on all platforms, not just Robinhood. It happens across all types of platforms: Charles Schwab, Merrill Edge, Vanguard, Fidelity, SoFi. Did I say Merrill Edge? Merrill Edge, because that's mine, and I've definitely seen like outages and things like that. Your money is still secure with them. That's okay. So with this Johnson & Johnson, we don't really care about the current price at the moment, since we are buying it for the long haul, the long future. Now, price does matter a little bit, but if we're buying a stock when the market is an all-time high, a lot of these stocks are going to be overvalued in quotes, but 20 years from now, 30 years from now, especially if we're diversifying and buying an assortment of companies, chances are that a lot of these stocks are going to be way higher in 20 years than they are today. And if you still don't feel too confident of buying stocks that are near all-time highs, you could always buy stocks that are not performing as well, like at&t. And finally, I want to say that check out my song, Lazy Boy. It's probably playing in a couple seconds, if not now. I should probably be quiet so you can listen. And check me out on Spotify. I do have an investing course. I have an Instagram page. Search me up, Funancialism. Drop a like, drop a comment, and subscribe. Welcome to the channel. I should have said that at the start of the video. Funancialism.
I'm a lazy boy, all my money working for me. Chilling on the couch, what's on? Rick and Morty. Swimming through the cash.